Welcome back. We got a special video today, another small cap, which small cap is anything under $2 billion market cap. And you can see here, Rayonier Advanced Materials, they have a market cap of $350 million. So even lower market cap than Smith & Wesson, which was the previous lowest one that I did. But before we get started, because this video is going to be a little bit different, I want to reiterate that I am not a financial advisor. I actually have no formal education in finance. I got a degree in chemical engineering, and I've worked my whole career in manufacturing facilities. So that's my background. I got interested in investing, some years ago, and it took me a long time to try to figure out exactly how to think of these principles and stuff in a more intuitive sense, and that's what I'm trying to pass on. So my hope is that these videos teach you how to carry these thought patterns in other investments. So that's it. All right, so who is RYAM, Rayonier Advanced Materials? They are a chemical manufacturing company. That's actually not how I found them. I found them by, during the lumber crisis. I think it was in the middle of COVID, not lumber crisis, but lumber prices were going through the roof. I was looking at all these lumber companies, and RYAM, in addition to being a chemical manufacturing company, they also owned a lumber mill or, some lumber producing assets. Since then, they've sold the lumber assets and are trying to focus more on the chemical side, but you're going to see that's why the balance sheet is cash heavy and why we're in the position that we are today. Okay, so just look at these ratios. These are the lowest I think we've ever seen on this channel. PE of 3.6, all right? PB of 0.4. That means that the market cap, 349 million, is 40% of the equity. Okay, crazy. This is rounded. I think it's like 0.44, but same thing. All right, and then price to sales, 0.2 price to sales. Remember, we usually like to look at price to sales less than 1. I don't like using price to sales, but some people do, price sales around 1 is a good valuation. 0.2, okay, that would suggest 5 times upside. You can see how at first glance this is like a crazy valuation. Also, 1-year high is 11 and 1-year low is 5, which is actually pretty close to where we are now. We're only about 10% off from the 1-year low. So, like I said, this video is going to be different because there are some reasons why these ratios are lower, and I want to touch on those. But first, I want to show you the balance sheet because you're not going to see too many companies like this, so we'll start with that. Okay, so look at this total equity. It's flatline, but look at the absolute value, $800 million, right at actually 785. So the market cap is 349. So equity is all the assets minus all your liabilities. So in theory, what this is saying is that if it sold all of its assets and paid off all of its debt, it would have $800 million left over. Doesn't really work out like that almost ever, but still, you'd rather it be on the high end than the low end, and this is extremely high, $800 million. Okay, so what I like to do though is that total equity can include things like goodwill or intangible assets. So I always like to look at tangible equity or tangible book value, net tangible assets. They're all the same thing. It's your equity minus your intangible assets. So if I do that, tangible book value, not much change. It's a little bit. Now it's 752 instead of 780. So you can see, this is selling at a huge discount to tangible equity. You almost never see that. It gets better too. Let me write this tangible equity number down because we're going to use it later. 752 million. All right, now let's look at their working capital. This is crazy too. Okay, working capital is current assets minus your current liabilities. So current assets are all your assets that are either cash or expecting to become cash in the next year, and then all your current liabilities are debts that are due to be paid in the next year. That's a rough estimate for what it is, but you get the gist. All right, look at their working capital, $493 million recently. So they're selling, their market cap is lower than the working capital. That's crazy. You don't see too many companies like this. All right, cash, look at their cash and cash equivalents. That's $313 million. Now this has been growing because, they sold their lumber division, so it increased the cash, but still $313 million of cash in this company, and the market cap is 349. I'm gonna say that again, 313. So 313 divided by 349. 90% of the market cap is covered by cash. So is this a traditional Benjamin Graham cigar butt company that's selling for less than working capital? Well, there is one kind of red flag on the balance sheet. So one thing that a lot of, traditional value investors that follow Ben Graham like to look at is they look for net stocks. And net stocks are stocks that are usually selling below their net current asset value. So that's that acronym that you see over there, NCAV. And all that is your current assets, so assets that are due to become cash in the next year, and then you subtract out all your debt, all your liabilities. So here's kind of the first red flag, because if I do that, let me see, okay, I actually get a negative number. So they're actually carrying a lot of debt compared to their current assets. And the reason really though is that they have a lot of non-current assets. That's that non-CA. So Current assets, like I said, are assets that are due to be cashed in the next year. Non-current would be things like equipment, buildings, those type of assets. It's listed here, so they have non-current assets, but I'm gonna look at net PPEs. Well, here's non-current assets. So you can see they have $1.6 billion of non-current assets that we just did not include in that NCAV calculation. So, those have got to be worth something, right? And if I look here, a lot of those, or most of it, is net PPE. So PPE is property, plant, and equipment. And you can see that this makes up $1.1 billion of their total assets. So that's the reason why that NCAV number was negative, because we didn't include this and the other non-current assets. But I just thought that was interesting. We're going to come back to all this, I promise, whenever we get to the valuation. But let's run through some of the other financial statements, the income statement and cash flow statement, and see if we see anything else that might concern us with the company, because it's still super cheap. Okay, let's go. All right, total revenue first. Remember, we like to see this growing. It had a big spike here. We're not going to count that. Recently, it has been dropping, okay? To be honest, if a company's selling at as lower ratios as we saw, you can almost guarantee the revenue is going to be shrinking. Something's got to be wrong for it to be selling so cheap. That doesn't mean it's going to be a bad investment usually, but things don't become that cheap just because of fear alone usually, okay? It is what it is, all right? Let's look at EBITDA. I hate EBITDA, but I'm going to show you why, okay? So this is Yahoo Finance's normalized EBITDA, okay? So if I take their last 8 quarters, so take the average of the last 8 quarters, they have $44 million of EBITDA, which is earnings before interest, taxes, depreciation, and amortization, okay? So 44 times 4, that would give me a yearly number for EBITDA, so $176 million. So they're selling it like 2 times EBITDA, because look, the market cap's 350. So 350 divided by 176, 1.98. They're selling it 2 times EBITDA, which I know some people would say, well, shoot, the balance sheet's undervalued, and now the income statement's undervalued. So this is a, win-win. Well, let me talk about EBITDA for a second, because y'all know I've hinted at it, but now I'm going to do a deep dive on why I really don't like EBITDA, okay? We're going to go letter by letter. Okay, so EB, earnings before, that's easy to understand, right? Okay, I is for interest. So EBITDA does not count your interest, which just to me seems crazy. That ignores your debt load completely, and that ignores a fixed cost that has to be paid no matter what, right? Interest payments have to be paid. There's no, the debt collectors don't care if you're not making money, or, oh man, I'm having a down year. That doesn't work like that. You got to always pay your interest. So discarding that seems insane to me. It's almost like they just kept it in here because they want a vowel. I'm not talking about this company in particular. I'm talking about everybody who uses EBITDA, okay? T, taxes, earnings before taxes. Y'all know I am okay with that. I actually prefer to look at a company on a pre-tax basis. I just think it gives a better comparison. So I'm okay leaving the T in. All right, now let's talk about the D and the A, depreciation and amortization. Depreciation and amortization are representing how much your assets are losing value in that time period. So depreciation is for physical, tangible assets, and then amortization is for intangible assets. I'm actually okay not including the A, amortization. I think that's fine to add back into your income, because intangible assets aren't always losing value. Depreciation, on the other hand, though, no, that's a real expense, okay? Because you have physical, tangible assets that have a lifespan, and if you're not accounting for that, to me, that's just crazy. It's a real expense. I could see maybe substituting CapEx for depreciation, but that still gets a little complicated, and you might as well just use cash flow. And then you still have the problem of including the I there, which is crazy. Okay, so that's how it's a real expense, and let me tell you why it's also CapEx and depreciation are some of the worst expenses, okay? So think about an insurance company, and we've talked about how insurance companies are such great business models before. I talked about that, I think, in my Disney video. But basically, what makes insurance companies great is that you pay a premium. So let's say you have car insurance and you pay them $1,000 a year. So you pay them $1,000 every year. And then maybe after 5 years, you need a claim, and so they pay you back like $6,000. And you think in your head, oh man, I paid $1,000 a year for 5 years, so really I made $1,000. Well, that's not the case, okay? Because if they paid you $6,000 back, they actually made a lot more money than that, because what they did was they took that money that you paid them for the premium and they invested that and kept all the returns and just gave you back, what you had paid them plus a little bit extra. It's a great business model. You're getting cash up front on a regular basis, and then at the end you have to have a payout that's pretty much equal to the cash that you brought in, so you have all this time to invest and make more money. How does that relate to CapEx and depreciation? CapEx and depreciation is like the exact opposite of that, okay? So CapEx is a ton of money all at once. And then the benefit is that you get to write off that expense in the form of depreciation. So you get a little bit of money back as a tax write-off every year for that time span. So it's like the complete opposite. You have to put all the cash up front and then slowly recoup the depreciation tax write-off. So it's a real expense, and it's one of the worst expenses. So that's my rant on EBITDA. Real quick though, I want to show you their Q3 2021 PowerPoint because it's just funny. Okay, so here's their third quarter financial presentation. This was on November 2021. They should be posting their fourth quarter soon, I guess. Okay, so what I'm going to do here, and I've done this before, is I'm going to Control F, search up here for EBITDA. See how many times it comes up in their presentation. Because if it comes up a lot, then that means that they're trying to hide other stuff. Or, if a company's flaunt EBITDA, like I said, it usually means they have high interest or high depreciation that they want to ignore. All right, 28 times. Oh my God, okay. Let's see all these times. EBITDA. Oh man. Okay, you get the point. They have 23 slides and it comes up 28 times. So it's more than once per slide that they mention EBITDA. That's like nails on a chalkboard to me. But stock's still cheap, so we'll see. It could still be a good investment. And I haven't even looked at the operating income yet, so let me do that. Let me pull up the financials again. All right, so going to operating income. This will be what their income is before interest and taxes. So this will include the depreciation and stuff. Yeah, not so great. So what were we before? We were like $44 million a quarter. So if I do the last 8 quarters, now I've dropped to 8.5. So I went from $44 million a quarter to 8.5. 44 EBITDA, 8.5 operating income. Not great. All right. Let's see their interest. Net interest. Oh man. $15 million a quarter they're paying in interest. Now it is decreasing recently, but holy cow. They're paying almost double their operating income in interest payments. That's insane. No wonder they like EBITDA. Okay, so now I'm going to look at their pre-tax income, and I got a feeling it's not going to be pretty. Yeah, negative. If I take the last 8 quarters here, let me just remove this one data point to get the scaling right. Yeah, okay. If I take the last 8 quarters here, I get an average of negative $13 million a quarter. Damn. Negative $52 million a year. How do I even account for that? The hell? Minus 52 million. Okay, let's go look at the cash flow statement because it's actually a little bit of a different story there. Okay, so here's their free cash flow, and you can see this is positive. So, cash flow being positive, if I had to pick between positive income or positive cash flow, I would pick positive cash flow all day, right? So I do prefer seeing this. This spike here, I'm not going to count. I'm pretty sure that has something to do with the lumber sale or even just the high lumber cost at the time, which they don't have that division anymore, so I'm not going to count that. So I'm going to take an average of these 4 that were right before that and include this one as well. So if I do that, my average is right at $20 million a quarter. Okay, so 20 times 4 is $80 million. Much better. Okay, so cash flow is much better than income, but I'm also kind of curious as to why. So let me put this down here. And usually, and we talk about this all the time, if cash flow is different than operating income, you want to check depreciation and versus like CapEx. So if I look at their depreciation and amortization, yeah, they're, holy cow, $35 million a quarter in depreciation. Wow. So they got a lot of assets that are depreciating fast, and it's a real cost. Like I said, I don't think that you can ignore it. I could see maybe substituting it for CapEx, and we're going to look at that real quick. So let me look at their capital expenditures. All right, so this is why free cash flow is so much higher than pre-tax income. Their CapEx is much lower than their depreciation. Remember I said their depreciation was like $35 million. We just looked at that. The average of the CapEx is $20 million. So they're spending a lot less on capital expenditures than they're depreciating. Warren Buffett has said, and I've listened to multiple interviews where they say they find it very difficult to run a business where you spend less on CapEx than depreciation. And usually those businesses are ones that aren't, big manufacturing companies. They're usually things that have very little asset requirements. So this spooks me a little bit just because I'm a little worried that they're spending so little on CapEx that they're probably just not keeping up with equipment, that stuff's depreciating faster than it's being fixed, and it's a little scary. But at the same time, as an investor, you'd rather see them generating more cash and being more conservative with their capital expenditure. So it's okay. I mean, it's just something that you need to know if you're going to value the stock. All right, so let's go to valuation. The typical valuation does not apply here, all right? This is completely different. So I'm gonna go to my DCF page. Let me pull that up. This is my discounted cash flow calculator. Man, what am I gonna do here? Okay, so there are a couple different ways to try to value this. So one way would be to just say, man, what's the net present value if they liquidate 4 years from now or something like that, which would be, you just put in their tangible equity right here, 752, and don't put any more cash flow. It's like they generate cash flow one time and then discount that back to a net present value. And you can see that our discounted value is $430 million, okay? So that's a crude way to doing it, but just to put that in perspective, $430 million divided by the number of shares, that'd be like a price of $675 versus right now it's selling for $548. That being said, if a company was going to liquidate, they're not going to usually liquidate for full equity value. It's going to be much lower than that. The assets are probably going to sell for, at least only 50% of what they're worth. I could see the current assets coming in right at what they're worth. To me, that's definitely not enough of a margin of safety to base it purely on that. The question here is going to be, what's their future earnings going to look like? Because they have a great base for the balance sheet. If their earnings start, rising and maybe even matching free cash flow. So let me just show you on a free cash flow basis. I'm going to just pull this up and put 80 here and just say that they're going to sit there, 0% perpetual growth. My discounted value is over 600 million, so close to double the market cap. Not double would be 700, but still, that'd be nice. The average of their pre-tax income and their free cash flow, that's, let's see, the average of 52 and 80, so minus 52 plus 80 divided by 2, that average would be 14. Man. If they make 14, now my market cap is only $107 million for the market cap, which would, that would mean the share price would fall lower. So the question is, what's the future of this company going to be? I think there's a lot of potential here. This could be a company that could 5x easily, even without much growth from a stock perspective, because if earnings do start growing and free cash flow stays about the same, people are going to see this stock that's, selling at such a low multiple of equity, and it could be a great thing. For me, I've had a love and hate relationship with this stock, okay, and this company in general. Whenever they were making a ton of money during the lumber shortage, I loved them, and I actually made a good amount of money on them. But recently, it's not been too fun. I don't currently hold any. I've just kind of shifted my investing philosophy to invest in companies that I just feel very good about, that make me sleep easier. This one is one that I feel like I have to follow every step, and I didn't like that. I like maximizing dollars per hour. So if I don't have to spend as much time on a company after I've already made my decision, that's better to me. But that's just my opinion. I know we didn't get an official valuation number, and I hope I explained why. I mean, it's just so hard to do, but I think that this company has a lot of potential, and it is a great opportunity for just learning about investing. And if you want to pick a company to watch and see how it turns out, I think it's pretty neat. So I hope you enjoyed the video. I hope you learned something. If you did, like and subscribe. I'll see you next time.